let's just jump right into this, man. So I'm going to go over my trading strategy. I've been funded 3 times with this strategy. And again, I'm not going to say it's mine just because I trade ICT concepts. I've learned a lot from ICT. I've learned a lot from Dodgy. But this is the way I trade. It's been working well for me. I like it. It's a high win rate. I like trading the lower time frames. And yeah, let's just do this. So the first thing that I like to look for going into the day is higher time frame key levels. So that's going to be in the form of either breaker blocks or higher time frame fair value gaps. So what I'll do when I start off the day is I will look for these higher time frame areas of interest and I will mark them up. So for example, let's say this is price here. Let's say this is price here. Going into the day, let's say we have equal lows below. Equal lows below. And let's say we put in a order block like this, like so. So let's say that this is the 15-minute time frame. I'm watching price and I am marking up these higher time frame zones. So for example, this is our 15-minute breaker. Price comes down and taps into that breaker. I am not interested in this zone until price taps back into it. And once price taps back in, once we enter this higher time frame PD array, that's when I'll hop onto the lower time frame and start looking for my entry model, which is going to be the inverse fair value gap. So let's look at a live example here. This was a beautiful setup from a couple of days ago. And for those of you that don't know what an inverse fair value gap is, it's basically when a fair value gap gets inversed and disrespected back to the upside or downside. So as you can see, we have a 1-minute fair value gap here. It's not the cleanest, but it's there. And normally, if price wanted to continue going down, if price wanted to be bearish, it would respect this fair value gap and start dropping to the downside. But the fact that price closes above this fair value gap means that price might want to start reversing. Again, we have another fair value gap here, and if price was truly bearish, it would tap off this fair value gap and then continue to drop. But because it doesn't, this could be a great point for a reversal. And what happens? We close above this fair value gap here, and then we continue to go up. So this is the entry model that I like. This is the model that I will look for on the smaller time frame. But let's continue looking at the higher time frame here. So this is 7:45 before market open. Let's play price a bit, and what do we see? What do we see here? We see a couple things. First of all, we have relative equal lows down here, which is a great liquidity pool. So I'm looking at this for a target for the day. So I have these marked up. I have these relative equal lows marked up. So 2 great targets going into the day. And what do we see? We see a breaker block here on the higher time frame. We swept yesterday's high, which means that we may want to reverse. So everything here looks great. So I'm watching this on the higher time frame, and I am waiting for price to tap back into this higher time frame key level to look for a potential entry. So let's hop onto the 1 here. So the 1 looks a little bit messy. We have a fair value gap down here, but we don't really have any entries in this price leg. So let's look on the 2. Okay, fair value gap up here and a fair value gap up here. Take a look at the 3. The 3 looks a lot cleaner in this scenario. So in this case, I would mark up this 3-minute fair value gap and I would wait to see if this gets inversed. This would be my entry. So again, I know that we have this breaker block. I know that we've tapped back into the 15-minute breaker block. So I'm jumping onto the smaller time frame and then looking for this entry model right here. In this scenario, we tap into the 15 and we create a 3-minute. If price wanted to continue going up, what it would do is it would tap into this fair value gap, bounce off it, and then continue trending upwards. The fact that this candle closes below tells me that we may, for the most part, want to continue to drop. And that is a risk that I'm willing to take. It's very high probability. So in this scenario, As soon as we close below this fair value gap here, inversing it, I'm hopping in short, putting my stop above this inverse fair value gap, and then I'm targeting these equal lows. And let's see what happens. Bang, we take those equal lows out. So this is a beautiful example of how I use a higher time frame to look for my trades. Again, breaker block, we swept yesterday's high. We tap back into this. And yeah, the reason I wouldn't take this on the 15 and the reason I love jumping onto the lower time frame is, let's say you entered on the 15-minute as soon as you got the retest. The risk to reward on this trade really isn't that great in this scenario. Let's say you enter here. Look at the 15-minute candle before this retest. This 15-minute candle is huge. That's 183 points. So who knows where this next 15-minute candle could go. You could get a 15-minute candle printing all the way up here, and now your stop is massive. So that's the reason I like jumping onto the lower time frame, just because it's a great way to tighten risk. So for example, looking at the 3-minute here, we close below this fair value gap, great indication we want to go lower. Stop right here, and a stop would be if a 3-minute were to close back above this. So let's say we had a candle print like this, a bullish candle, and close back above this gap, I would be out. I'd be stopped out of this position. In this case, we retest it and then continue to drop. So this is a great way to tighten risk, trading or looking at the higher time frame. If you don't want to trade the 15-minute or even the 5-minute, you can always hop onto the 1 or the 3 or the 2 and look for your entry model on the lower time frame. Okay, I filmed the second part of this video in slow motion and just found out while trying to edit it today. So we're back on and we're going to try refilming the second part. So here we go. The second entry model that I like to take, the second type of trade I like to take, is the reversal. So the reversal is quite simple. Let's say, again, this is the 15-minute chart. And we're sort of range bound like this. And we put in a very obvious low. So this could be, again, 15-minute chart. This could be a London swing low. This could be a New York low. This could be previous day low. So let's just say that this is a very important low, a very key level. What I like to do is wait for price to take these key levels, and then as soon as it takes a key level like this, I'll hop onto, again, the smaller time frame, so the 1 minute. I'll enter the 1 minute time frame here and then look for a reversal after sweeping a key low, and that reversal comes in the form of, again, an inverse fair value gap. So what I'll do is I'll mark up any key lows on the day. So these could be relative equal lows. This could be a key low, a place to look for a reversal. It doesn't reverse, price keeps dropping. We hit another key low, and then I'll drop onto the smaller time frame and then again start looking for a reversal. So let's look at this in live time. We had a perfect example of this on Wednesday. So going into the day, we immediately just started taking a dump. We took a shit for about 200 points, and I'm not going to try to short just because price is dropping. I'm not going to FOMO. I'm going to wait, and I'm going to sit on my hands until I see an entry I like. So going into the day, what I did was marked up these equal lows here as a potential target. We immediately sweep them. I had this low marked up, and I had this low marked up. This is Friday's low from last week. These are equal lows, and this is also a London low. So this is a very key level. So simply what I do is sit on my hands and wait till these lows get taken. So right here, we take this low. So I hop onto the 1 minute and I'll sort of go over my thought process. In this case, we take this very obvious low, we put in an inverse fair, or sorry, we put in a fair value gap here, and we inverse it. So I actually took this trade, but I got stopped out at break even. So my entry was here, my stop was below this order block, and I was targeting these relative equal highs up here. So this was my TP, and we entered this trade. as soon as we took this low, inverse this fair value gap, as soon as this candle closes, we enter, and we printed about 14 points in the winning direction. So we were 14 points bullish, and I decided to put my stop to break even. I was up 14 points. That's quite a bit for me, as my average winner is probably 20, 25 points. So at that stage, I'm okay to put my stop to break even. So as soon as we're up here, I slap my stop to break even, and as you can see, price reverses, stops me out at break even, and we keep dropping. So in this scenario, I've accepted that this low may not be the low that we're going to take before we reverse. So what do? I look to the left for other important lows. I accept that break even, and I see this low right here. So I have this low marked up. I've realized that we may want to continue dropping. As you can see, we get a lot of displacement below this low. So boom, boom, we start printing lower. And at this point, I know that this is probably going to be the next low that we're going to sweep. This is our next target. So as soon as we take this low, I do the same thing. I wait to see how we react. And in this case, as you can see, as soon as we take this low on the 1 minute, we dip below by about 10, 15 points, and then we immediately get a big green candle printing back to the upside. So what do? I look for my entry model on the shorter time frame, on the smaller time frame, and I mark up any fair value gaps. So we have a fair value gap here. We have a fair value gap here. And at this point, I'm waiting to see how this next candle is going to react. So in this case, we take this obvious low. I then drop to the lower time frame, start looking for my entry model, and then we get this massive green candle. So the fact that we inverse not just one, but two fair value gaps like it was nothing with this big bullish candle here means that this could potentially be the point for our reversal. That is a risk I'm willing to take. So I enter long as soon as we close above this fair value gap here, inversing it. I wait for the retest. I put my stop below this here, which would be a smaller breaker block. So stop below the breaker block, entry as soon as we tap back into this inverse fair value gap, and my exit was at this swing high here for a 1 to 3.6. So very clean trade. You can see that it can be very beneficial if you do catch the reversal, considering you could get huge moves like this. So I was okay with my 1 to 3.6, 1 to 3.6. But if you have some patience, if you do catch the real reversal, you can see that you can capitalize on some pretty big moves here. So that is the second trade I like to take. I like to mark up very obvious highs, lows, and then as soon as we take those lows, I like to hop onto the smaller time frame and then again start looking for inverse fair value gaps, because that's a great indication that price is ready to reverse after sweeping those big liquidity pools. Okay, now the third type of trade I like to take is actually a mix of both of these ideas combined. So that would be, for example, sweeping a higher time frame key low with a bullish or bearish PD array below or above that point of interest, supporting price in the direction that you want to expect it to reverse. So what I mean by that is, let's say we have a 15-minute fair value gap right here. 15-minute fair value gap right here. And then let's pretend that we have relative equal lows below. So a lot of the time after we sweep relative equal lows, there's a lot of traders stops resting there. A lot of retail traders are expecting this to be an area of support. This is a double bottom. So what price likes to do a lot of the time, it will sweep these equal lows or equal highs and then reverse. So in this case, we have our obvious low marked up, which is going to be these relative equal lows. And below this point of interest, we have a bullish higher time frame PD array that should support price. So this is a very effective entry strategy. You basically wait for your low to get swept in this case and price to enter your higher time frame PD array. So in this case, we're stopping out all of these traders who have stopped resting below these equal lows. Stop these traders out. We enter our higher time frame PD array. And at this point, you can expect price to start to reverse. So again, you'd be looking at this on the higher time frame, and then as soon as you enter your area of interest, you can hop onto the one and then start looking for your entry model. Now your entry model can be whatever. It could be an order block, it could be a breaker block, but in my case, it's still going to be the inverse fair value gap. And a perfect example of this trade, which played out on Tuesday, would be right here. So going into the day, as you can see, we have this very key level here. We have relative equal lows. There's going to be a lot of stops resting below this area, and price loves to come back to equal lows. So not only do we have our key low marked up, but we also have a 15-minute bullish PD array, a bullish fair value gap below this point of interest, which will also help support price. So again, this would be a great area to look for a reversal, because not only are we stopping all these traders out down here, we're sweeping this key low, but we also have a bullish PD array supporting price right beneath our area of interest, right beneath the lows here. So if you play price a little bit, you can see that it was a relatively choppy day. We had 10 p.m. red folder news, and as soon as 2 p.m. red folder news, and as soon as 2 p.m. hits, we immediately target these lows, stop all these traders out. We enter our higher time frame 15-minute PD array that we have marked up here. So again, this is a combination of the two ideas. This is a bit of a double whammy here. And as soon as we enter this zone, we can now hop onto the one and then start looking for our entry model. So as you can see, we sweep the low, we enter the 15-minute here, but we don't get an entry. We get a little bit of a push back up, and price is still respecting these bearish fair value gaps. So again, this could be an indication that we're not ready to reverse yet, and price comes back in. We sweep this low here, which is an added bonus. You love to see a sweep of liquidity on the smaller time frame before going back up. So this could be considered like a fake out, for example. So we fake some traders out, looks like it's going to reverse. No, not yet. We respect this bearish fair value gap. We drop, we enter the 15-minute again. We leave the fair value gap here, and this is our entry model. We leave a fair value gap, we sweep this low, stopping these traders out on the fake out move, and then we close above the fair value gap, inversing it, holding our higher time frame zone. And again, your entry model would be a close above, so you could enter the trade here, and you could put a stop, let's say below the order block, a hard stop down there, and then target whatever you feel like targeting. So in this case, the trade played out beautifully. We retested the inverse fair value gap here and used it as support to go back up to the upside. So there was a little bit of drawdown in this play, but not much. You wouldn't have been stopped out. And then as you can see, after we retest that 1 minute, the 1 minute inverse fair value gap, we start respecting it back to the upside, and then we get that reversal. So again, this is a combination of the two ideas together. It works very well. And yeah, that's basically the video summed up. I just want to say I'm no pro. I'm not trying to be a teacher or a guru. I'm simply just trying to make this video to show you guys what has worked for me and how I sort of use the higher time frame to increase my win rate and just increase my confidence in taking these trades overall. I know back in the day, I would sort of just take any inverse fair value gap I saw without really aligning the higher time frame or looking at higher time frame levels. And this has been a huge game changer for me. Okay, the camera died there. I had to go to work. But basically what I was saying to sum up the video was you need to make sure that the higher time frame aligns with your trade ideas or you will get smoked. So my one piece of advice and what really changed the game for me was waiting till price hits my higher time frame key levels and then looking for my entry model, rather than trying to force these rinky-dink little shitters here and there that don't have any confluences with the higher time frame. So lock in, start studying the higher time frame, and you will increase your win rate. Higher time frame zones as in order blocks, breaker blocks, London highs, London lows, previous day highs, previous day lows. And yeah, that basically sums this video up. I hope you learned something, and let's hit some nice trades this week.